Nowadays, the world is experiencing global uncertainty. Food and fuel prices are constantly rising, and inflation is reaching historic highs. Under these conditions, it's essential to know how to protect your capital from devaluation. We will talk about the best safeguard for your money, gold, how to buy it, and how much you can earn from it. Let's begin with the question, why are gold transactions called investments rather than purchases or speculation? The fact is, gold is an international equivalent to which the value of all global assets and currencies is tied. Gold will never depreciate, unlike fiat currency. And the less gold remains in the earth, the higher its value will be. For this reason, large institutional investors hold gold in their portfolios not for years, but for decades. Gold is often used to store wealth to protect it from devaluation, because the average fluctuations in gold are much smaller than those of currencies or stocks. As I already mentioned, pure gold has been regarded since ancient times as a universal good that could be used for any exchange. Initially, simple pieces of gold were used, with value determined by weight. Later, people learned to melt gold into bars and coins. It was at that time that the standard and still existing weight unit of 31.1035 grams of gold, the troy ounce, was introduced. After gold began to be traded on the stock exchange, its price started to rise sharply, as it was always considered the primary measure of wealth. The first attempt to abandon gold as a standard was made by several countries in the mid-19th century. These efforts ended with the collapse of their economies, and the spot price of gold simply slowed its continuous rise. The most significant and well-known attempt to abandon gold was carried out by the central banks of developed countries at the end of the 20th century. At that time, they were actively selling off their gold reserves, reallocating funds into short-term financial projects. We all remember how that turned out, with the 2008 crisis, when all those projects lost their value, and with the famous surge in gold prices, from $300 to $1,200 per ounce. In 2023, gold even reached an all-time high of $2,062.30 per ounce. I don't need to explain how much those who bought gold profited. For many decades, gold has ranked among the world's three most liquid assets, along with oil and the US dollar. Moreover, it is an unrivaled safe haven asset for any amount of capital. Worldwide, investment performance is commonly represented by the ROI, or return on investment. Let's compare the performance of investing in gold with investing in Microsoft shares from 2018 to 2020. As seen in the chart, during this period, investments in Microsoft stock generated a higher return than buying gold contracts. And that's no surprise, since company stocks are risk assets, and their price fluctuations are significantly greater than those of stable gold prices. However, unlike stocks, which can also rapidly lose value, the price of gold tends to be more stable. Another important feature of gold is its ability to protect money from devaluation. Rising inflation always leads to subsequent increases in interest rates, which negatively impact risky assets like stocks. This is due to the growing appeal of bonds and bank deposits, which are more conservative than corporate stocks. In such situations, investors always shift their capital from stocks to gold, which in turn drives up its price. Modern economic and investment service development offers investors many ways to invest, from purchasing gold products to buying gold contracts on the stock exchange. Despite the development of stock investment instruments, people generally prefer to store their money in something tangible. That is why the most popular forms of investment in precious metals remain gold bars, gold coins, and gold jewelry. This type of investment is more suitable for large investment funds or banks, as it involves several challenges. For example, the main issue with this form of investment is the storage and transportation of the metal. Gold is a very heavy yellow metal, and when purchasing a significant amount, one must consider logistics and storage, which entail additional costs. Moreover, when buying gold bars, you pay a mandatory value-added tax, which can be reduced if the bars are stored in the bank vault where the gold was purchased. In some cultures, this form of gold investment is almost a national tradition. However, just like gold bars, gold jewelry has its downsides. First, it is very unlikely that you will be able to sell the piece at the same price you bought it. At the time of purchase, the price includes the jeweler's craftsmanship, but upon selling, only the weight of the item is generally considered. This form of investment has gained great popularity in recent years. Since early 2023, the U.S. Mint has reported a significant monthly increase in sales of iconic gold coins. Unlike gold bars, investment coins are not taxed when sold, making them the most attractive way to invest in physical gold. However, there are still drawbacks, mainly the condition of the coin at the time of sale. Even the smallest scratch can reduce its value, and thus the resale profit. Although people still prefer to buy physical gold, modern stock mechanisms offer alternative ways to profit from it. Among these options, exchange-traded ETFs, futures contracts, and CFDs stand out. A fairly popular method of investing in gold involves buying a special contract for difference, CFD, on the stock exchange. Its main advantage is that you can profit from both buying and selling gold, without actually owning much of it. Your money equivalent to the value serves as collateral for such a transaction. The contract usually carries the ticker symbol GOLD or ZOST. Another advantage of gold CFDs is the ability to fully control the operation. You decide when to buy, wait, or sell the asset. An ETF is an exchange-traded fund. It consists essentially of a portfolio backed by an underlying asset. In the case of gold-oriented ETFs, they are backed by physical gold and traded on the exchange like regular stocks. ETFs were created so that investors could earn income from the underlying asset without investing in the physical asset itself, and to diversify their portfolios, thereby reducing risk. The main downside of investing in gold ETFs is the high taxes and often fixed investment periods. As with contracts for difference, CFDs, futures can be both bought and sold. The only difference lies in the fact that a future has a contract execution date, after which the seller is obliged to complete the transfer. The final price of the future also depends on this date. In other words, you carry out a transaction under pre-agreed conditions, buying a certain amount of goods at a predetermined price at a specific future date. The advantage of a future over a physical asset is that you can use leverage, significantly increasing the size of the trade. In addition to investments in physical gold or exchange-traded contracts, some investors choose to invest in shares of gold-related companies. That is, they invest in shares of gold mining and processing companies. This is also a fairly competitive investment method, but it comes with some significant disadvantages. Even though these companies deal in gold, the value of their shares doesn't always fully correlate with gold prices. For example, one can compare the value of shares of the largest gold mining companies with the price of the precious metal. As you can see, from 2016 to the present, the return on Newmont Gold Corp shares was 246%. This means that every dollar invested in this company's shares would yield $2.46 in profit. Investments in shares of the Canadian company Kinross Gold would generate a return of 162%, or $1.62 for every dollar invested. Meanwhile, gold itself did not rise much during this period, gaining only 56%. Therefore, it's clear that investing in shares of gold mining companies is also a profitable type of investment. However, while the price of gold directly depends on supply and demand for the metal itself, the price of a company's shares depends on many additional factors. And these factors can be either positive or negative. For example, Newmont Gold Corp's shares rose sharply because in 2018, a merger with another giant, Barrick Gold, was announced. If the company had taken on a lot of debt and there had been a decline in gold extraction, its shares would have dropped despite the rise in the metal's price. So don't forget to research these kinds of company details before buying their stock. Now let's talk about why gold investment is considered one of the most reliable and profitable over more than 100 years. Gold preserves wealth. As I mentioned earlier, gold has always been regarded as the primary measure of wealth and prosperity. It is seen as almost the only asset that simply cannot depreciate. If the company whose bonds you purchase declares bankruptcy, your shares will be worthless. That cannot happen with gold, it will never disappear or lose its value. Moreover, the less it is produced, the more expensive it becomes. Gold is protection against the dollar and fiat currency. Lately, the dependence on the US dollar is causing increasing concern in the financial world. It is the only currency that can be printed in unlimited quantities. Consequently, the more dollars that are printed, the less valuable the money becomes. And this devaluation affects all fiat currencies. The only protection against this depreciation can be a product that cannot be devalued. And, as already mentioned, gold is a perfect option in this regard. Gold is a safe haven. Another excellent feature of gold is its stability. In times of global turmoil, gold prices have always been subject to only minor fluctuations. Even today, with global geopolitical uncertainty dominating the world and world currency values falling, gold remains within its long-standing range of $1,700 to $1,800 per ounce. Very often, gold is called a safe haven asset because there is no other asset with such enormous liquidity that experiences such small fluctuations. This is why investors around the world prefer to weather the storm in the market with the help of gold. Portfolio diversification. Even in the earliest economics textbooks, one of the main commandments of a rational investor is diversification. In simple terms, diversification means not putting all your eggs in one basket. In investment language, this means you shouldn't invest all your money in a single investment instrument. It is much wiser to spread it across several unrelated assets. An ideally diversified investor portfolio should include multi-directional assets. Gold is one of the best diversifiers, as it has a historically negative correlation with stocks. Many times, when stocks fall, gold rises. Liquidity. The main feature of an ideal investment asset is the ability to buy or sell it quickly, in other words, liquidity. Gold is one of the three most liquid assets in the world. Therefore, gold transactions are much safer than real estate or other tangible asset transactions. Gold can be bought and sold on the stock exchange in a matter of seconds. Hedging. Another characteristic of gold is its ability to hedge financial risks. If you're an investor, your main fear is a possible crisis and a stock market collapse. Just look at gold's chart. During every major crisis, it has always increased in value. Therefore, holding gold helps partially offset losses in the event of a sharp downturn. Global demand. Everyone needs gold. Most countries in the world are steadily increasing their gold reserves because the strength and stability of an economy depend on their size. Moreover, gold is valued for its properties. For example, it is durable and does not corrode. Because of this, gold is always in demand in the jewelry industry, which will continue to consume it regardless of its price. If you enjoyed this video, please don't forget to subscribe and give it a like. See you soon.